The U.S. stock market is closed for the weekend. I can tell you that Strive Incorporated, trading under the ticker ASST, closed the session on Friday, November 14, 2025, at $1.08 per share. It was a rough day for the stock, finishing down nearly 6.1%, shedding about 7 cents on absolutely massive volume of over 117 million shares. Now, if you saw that ticker, ASST, cross your Fidelity trading platform or pop up on a SoFi Invest screener, your first thought was probably, oh, that's that asset management firm, the anti-ESG people. That is the common narrative, the expectation. You're thinking about ETF flows, management fees, and the firm's political stance. But the reality is, if you're trading ASST based on that assumption, you are missing the entire story. What just happened to this company is one of the most complex transformations we've seen this year, and it has almost nothing to do with managing Fidelity ETFs anymore. The company you think you're looking at, Strive Asset Management, has effectively been consumed by a new, much wilder strategy. The new entity, Strive Inc., has completely changed its business. It just completed a reverse merger and has remade itself into a publicly traded Bitcoin Treasury company. This isn't an asset manager anymore. It's a highly leveraged, speculative bet on a single digital asset. The 117 million shares that traded hands on Friday weren't asset management investors. They were crypto speculators, arbitrage traders, and terrified shareholders reacting to the company's brand new third-quarter financial results, which were just released. So let's establish common ground. For the past couple of years, Strive Asset Management, founded by Vivek Ramaswamy, made a lot of noise. They offered Fidelity mutual funds and ETFs like the Strive 500 ETF, STRV, that were built on a mandate to depoliticize corporate America, a direct challenge to the ESG movement. For many, this was a compelling investment thesis. You could use your individual brokerage account to buy funds that, in theory, voted their proxies for pure profit maximization, not social agendas. They positioned themselves as the go-to for self-investing individuals who felt left behind by the prevailing corporate winds. But here's the challenge to that belief. That business, as a standalone, is now just one small, almost incidental part of a much larger and frankly much riskier public corporation. The new Strive Inc., ASST, is a different beast. It's playing in the same sandbox as companies like MicroStrategy. Its primary goal is no longer just managing Fidelity brokerage accounts or offering Fidelity IRAs. Its stated goal is to acquire and hold Bitcoin on its balance sheet, using its status as a public company to raise capital. The massive volume and the price drop on Friday make perfect sense when you see this new reality. The company just reported its Q3 2025 financials, and the numbers are staggering. We're talking about a GAAP net loss of $192.3 million. That's not a typo. Now, the company is quick to point out that $179.3 million of that is non-cash items, but it also just announced it has accumulated 7,525 Bitcoin as of early November. This is where the story gets really complicated. This isn't like you buying some Robinhood crypto on the side. This is a corporation fundamentally tying its entire balance sheet to the price of a volatile asset. To fund these purchases, they just completed an offering of a new security, a Series A perpetual preferred stock, trading under the ticker SAATA, raising about $149.3 million. This is a classic aggressive capital markets move. Sell one type of paper, preferred stock, to buy a digital asset, Bitcoin. Common shareholders, the ones holding ASST, are now at the bottom of the capital stack, and they are watching their equity get diluted to fund a massive directional bet. The 117 million shares in volume was the market trying to figure out what this stock is even worth now. This is a far cry from just providing investment help or being one of many investing sites. The company's strategy is to amplify its Bitcoin treasury using this perpetual preferred equity. It's a structure that adds significant complexity. On top of all this, Strive Inc. is in the middle of an all-stock acquisition of another company, Semler Scientific, SMLR, which itself had previously announced its own Bitcoin treasury strategy. So Strive is acquiring another company to get its hands on its Bitcoin. This is M&A driven by a corporate-level chase for digital assets. It makes a normal investment in something stable like Apple stock, or even a high-growth name like Nvidia stock, look incredibly simple by comparison. Those companies make products. Strive Inc. is now in the business of financial engineering to acquire a single commodity. It's a bold move, but it's also one that carries extraordinary risk. If Bitcoin's price falls, the value of their main treasury asset collapses, while the cost of their preferred stock obligations remains. So what does this company, Strive Inc., ASST, actually do now? It's important to be clear because the old narrative is still floating around. The original Strive Asset Management, the one that manages ETFs and offers Schwab Intelligent Portfolios and other intelligent portfolio solutions, still exists. It's now a subsidiary of the public Strive Inc. But the parent company, the one whose stock you buy on the Robinhood app or through Interactive Brokers, is a holding company. Its primary business is now managing its Bitcoin treasury, raising capital via equity and debt, and managing its subsidiaries, which include the asset manager and, if the deal closes, Semler Scientific. Think of it this way. The relatively stable fee-generating asset management business is now the boring part of the company, bolted onto a highly speculative Bitcoin acquisition vehicle. It's a high-stakes play. They're using a public market listing, which is something platforms like SoFi or Interactive Brokers give you access to, as a tool for aggressive balance sheet speculation. This is advanced online investing, and it's not for the faint of heart. Looking back, the company's performance has been, as you'd expect, all over the map. ASST is the result of a reverse merger with a company called Asset Entities. The stock has a 52-week range between 33 cents and $13.42. That should tell you everything you need to know about its stability, or lack thereof. This is not a buy-it-and-forget-it stock for your Fidelity Wealth Management account. This is a trading vehicle. The old reports on Asset Entities are irrelevant, and the old reports on Strive as just an asset manager are incomplete. All that matters is what happened in the last few months. The merger, the shift to a Bitcoin treasury, the massive capital raises, and the Q3 report that just landed. We're watching a company attempt a massive strategic shift in real time, using public online investment markets as its funding source. Comment below with your thoughts. Do you think this pivot to a Bitcoin-first strategy is a brilliant move to maximize shareholder value, or is it an incredibly risky gamble that will end badly for common shareholders? Now, let's talk about the future outlook, framed by this new reality. The expectation might be that the asset management arm will grow and provide a stable floor. The reality is that the asset management business is now a sideshow. The future of ASST is tied almost completely to two things: the price of Bitcoin and the market's willingness to keep funding the company's acquisitions. If Bitcoin's price continues to rise, management will look like geniuses. They will have successfully used public markets to get amplified exposure. But if Bitcoin enters a bear market, the entire structure could be at risk. The $192.3 million of GAAP loss is a huge red flag, even if much of it is non-cash. It shows the volatility and cost of these complex maneuvers. The catalysts for this stock are no longer ETF flow numbers. The catalysts are Bitcoin's daily price, announcements of new Bitcoin purchases, and SEC filings about the Semler merger or new capital raises. The risks here are enormous. First, there's execution risk. Can management successfully integrate Semler Scientific while also managing a volatile Bitcoin treasury and a separate asset management business? Second, there's capital markets risk. What happens when the market stops wanting to buy their preferred stock? How will they fund new purchases? And third, and most obvious, is asset risk, Bitcoin itself. This is not Tesla stock, which, despite its own volatility, at least sells cars. This is a bet on the future of a digital asset. For many, that's a great bet. For a public company, it's a bold one. If you're a trader using interactive brokers,